Stretch is exploding. And of course, all of this is getting into DeFi versus TradFi. We're going to break it down for you today. You guys don't want to miss it. I do want to thank our sponsor, and of course, that is Tangm. If you guys are into self-custody, and you should be, jump over to the Tangm website, which is tangm.com. You can get going on this, and it's a card, works with your phone, very cool tech, and of course, one of the best thing about it, it's very easy to set up and easy to use as well. Jump in right now. I think it goes on until May 25th. They've got all kinds of additional discounts and some Bitcoin rewards, so check it out. Use the link down below. Let's get in today. I want to bring on Parker White, who's coming in from APYX. And of course, how are you, Parker?
Fantastic. Thanks for having me.
Tell me a little bit about you and your team.
Sure. So APYX was launched in response to what we saw going on with Stretch and with MicroStrategy. So some of the team behind APYX is the leadership team at DFDV, DeFi Development Corp. Okay. So it's the first non-Bitcoin treasury vehicle listed on the Nasdaq. We launched last April. But kind of as we saw the DAT space evolve, we saw what Saylor did, what Strategy did with STRC. It was actually the largest IPO of any kind in 2025. I think it was about a $2-3 billion IPO, and then it really grew from there. Not only grew, but it performed exceptionally well during the drawdown in February. We kind of saw the need for this type of yield on chain. And so we rallied the troops, got a couple other folks together, and kind of helped start this project. And the idea here is a kind of decentralized protocol that we help get off the ground, and then it, kind of exists into perpetuity with lots of folks around the table.
All right, so there's been the love and the hate of this thing that's out there right now, especially when you look at what some of the Bitcoin Maxis have been doing in terms of talking about this. I want to go to a clip by Matthew from Bitcoin University that kind of breaks it down, and I want to get your opinion after that. Take a look.
Craters, sure. Bitcoin University. Today I want to talk about Michael Saylor promoting shitcoins. And we turn Bitcoin into money and then Stretch. Let's take a look at the video.
And Strategy refines Bitcoin, turns it into Stretch. That's what powers my money. Stretch, 11.5% annualized dividend rate, paid monthly, listed on Nasdaq.
This ad is complete and utter BS. Also, probably not a good idea to smoke in an oil field and toss your cigarette into the oil well. I couldn't believe it when I saw this. Pendle now holds 2.4 million Stretch. If this looks like shitcoining, that's because it is. This is just DeFi at its worst. And to make things even worse, it's a token built on Ethereum. It's an ERC20 token. So many Bitcoin heroes slain. I don't know what to say. All I can say is that I miss this guy.
They think Saylor has defected. When you look at that, what is the argument to a Bitcoiner out there that says, no, this is actually maybe a good product for you?
Yeah, look, I think ultimately it comes down to what you want Bitcoin to be. If you would like Bitcoin to go back to the days, the 2010 days, 2011 days, where it was kind of a pet project amongst some cypherpunks, some nerds that kind of, mined in their basement and stuff, then this is all bad, and we should get rid of all this. We should get rid of the BlackRock ETFs. We should, get rid of the exchanges. We should go back to local Bitcoins. Some people like that, and there's plenty of projects for that. But I think for most Bitcoiners, and I myself would consider myself a Bitcoiner, the idea is to have all of global finance built on top of Bitcoin. That's the vision. That's how you get to tens and hundreds of trillions of dollars value, stored within Bitcoin. And the only way to do that is to proliferate it and have it be everywhere at all times. To say, Ethereum is evil, you don't have to like Ethereum, but what you can like is the fact that people on the system are effectively buying Bitcoin. I mean, it's making a couple hops. It goes through us, then it goes to Strategy, and then they buy the Bitcoin with it. But it's essentially value being moved into Bitcoin. That's great. Maybe you don't like Ethereum, but, I'd say maybe you shouldn't like the Nasdaq. You shouldn't like the NYSE. You shouldn't like banks. You shouldn't like exchanges. It's just another kind of platform, if you will.
Well, I think Saylor has kind of gone on record here. This is an evolution in, creative finance to really kind of solve the bigger problem, which he is trying to do, and that is buy more Bitcoin. I'm looking at your website here. This is APYX DeFi, if you guys want to kind of follow along here. APYX USD and APY USD, all right? The yield wrapper won the dollar. Explain how you're utilizing these two in APYX.
So in very simple terms, APYX USD is kind of a standard stablecoin. Now I should caveat that, it may depeg a little bit. Obviously Stretch can move around, the price can move around. And so you could expect the price on APYX USD to move around. But other than that, it's a very standard, stablecoin. Doesn't pay yield. It's an ERC20, moves around, whatever. But then from there, you can stake it or lock it. And when you do that, you get APY USD. It's like your staked token. And that pays, we target about a 13% yield. It can fluctuate. It typically kind of drifts down as more people come in, and then we top it up each month. So say, between 11 and 13% for just holding. So that's the APY USD, staked version of APYX USD.
Explain how the dividends get paid, because that was a little bit different than I had seen before.
Sure. We pay out the yield kind of in real time, on a hourly basis, throughout the day. And so people are able to accrue the yield, accrue the dividend, over time. And this is different than, say, STRC, which right now pays monthly. They're pivoting to bi-monthly, or even different than SEDA, which pays daily, but only during, business days. And so we essentially take the yield that we get, and then we spread it out. So we kind of, even it out. So whereas the yield on these, on the underlyings is pretty lumpy, we make it smooth so that people can come in and out and get yield for, just the time that they're in.
They are talking about, when we had their CEO or their president on a couple of weeks ago, he was talking about they were trying to go to where they would have this twice a month potentially versus what is now one time monthly, which is usually around the 15th on this. So do you think that would make any difference in terms of how your product would be viewed if we started to see more frequency coming out of the traditional asset?
Sure, and I hope we do. I mean, SEDA or Strive rather has kind of the other major preferred in the market, and they just announced they're switching to daily dividends, which is historic. Daily has never been done before, and so I assume Strategy is going to follow suit and eventually go to daily, and that certainly makes our lives easier. Because right now we kind of like collect the dividend and then we pay it out over the following month, and it creates a little bit of operational issues for us. And so this would certainly make it easier. It would also make the underlying instrument less volatile. So on a day like today, 2 days after X dividend, the price is down a little bit, right?
Right.
And if you had dividends being paid every day, then I think you would have even less volatility and you would kind of smooth out and be pegged more right at 100. Hopefully they do it because it would certainly make our lives easier. But our product is, fundamentally different and not contingent on just the, daily smoothing thing that we provide. That's, not really the core value proposition.
Do you think this is going to be the case where we see this mostly being traded on DeFi? Do you think that's where the growth could potentially go?
Not really. I think there's going to be a lot of growth in DeFi for sure, but traditional markets are just far larger than DeFi. I mean, there's only, 300 billion of stable coins total globally in DeFi where this would be a fit. And sure, maybe there's some new dollars that can flow into the space, but largely what it is people rotating out of existing stables into this. So 300 billion is like the top max versus the TAM for global credit markets is in the, tens or hundreds of trillions, right? I mean, you look at all the capital that's stored in private credit, in, more traditional credit, fixed income, so on, even like real estate, all these different high single digit and low double digit yield instruments that can all flow into Stretch. It'll take time, right? As with any new instrument, it'll probably take, 4, 5, 6 years, maybe a decade before this thing is a multi-trillion-dollar asset and asset class. But I think it's going to grow pretty significantly, and the majority of the dollars are going to come out of TradFi. I think the reason Saylor is so excited about it right now is because DeFi capital is typically more, has a much higher risk appetite. This is, I would say, a short-term pool for him where he can get, let's call it a few billion of additional capital. Maybe it's like 10 billion of additional capital over the next, 12 months. But beyond that, he's really, I think, going to tap out the DeFi market. And so he's going to need more of that TradFi capital to come in. But these guys want to see an instrument in the market for, quarters, years, even beyond that before they really pile in. So he just kind of needs to build that time. And so in the meantime, he can rely on the DeFi capital to continue to grow.
Well, and if you look at the the DeFi side of things, I mean, you can kind of see the growth is pretty accelerated here. So I don't know, man. This looks very intriguing to me in terms of where this could go. But I agree with you. Granted, once we get institutional capital or even traditional finance coming into these, I guess the question is when would the appetite take on? Because some investors who are maybe seeing Stretch for the first time, the ones that understand it, I think, are the ones that probably understand DeFi a lot, and that's why we're seeing so much growth here right now. So,
if Stretch moves to a daily dividend, I think that'll be a real interesting kind of wake-up call. Because again, it's like Bitcoin or otherwise, it's very unique to have an instrument that pays a daily dividend. It's never been seen anywhere else in finance before. I don't know, maybe look at like money market funds or something. So I think that'll catch some, raise some attention. And then I think candidly, you just kind of need the Bitcoin bull market to come back, and you need, global eyes on the space. And when they start looking at the space, they'll see Stretch, and you'll start to see more adoption. So, for better or worse, I think Bitcoin price is, kind of needed to go up here.
You're mentioning 10 billion in the DeFi markets. That would double Stretch's, position right now.
Slowly and then kind of all at once.
Oh, okay.
Right?
All right.
Over the next, let's call it 12 months, maybe we can get 10 billion in on the DeFi side. But on the TradFi side, that probably means Stretch has raised another 40 billion maybe outside. So maybe it's like a total of 50 billion. And then at that point, I think traditional finance really starts to wake up.
Okay.
Once it crosses that 50 billion, maybe it's 100 billion mark, then it becomes a really, an interesting instrument. Right now at 10 billion, it's interesting, but you saw what Bitcoin had to get to before the sovereigns started to get interested.
Yeah,
giant corporates started to get interested. So you need kind of some of that to happen here. And that's just going to take some time.
The accelerant. So you've got this breakdown here of what you guys call senior tranche, which is a protected yield, and then the junior tranche, which is a higher risk premium. Explain these two on my yield strategy with what you guys are doing.
So to be clear, this is a separate protocol, Royco, one of our partners, but they are, entirely separate, and they can do this with other assets, and they have done this with other assets. But the general idea behind these tranching protocols, and Royco in particular, is that you take a yield-bearing asset and you split it up into two assets. And you have a senior tranche and you have a junior tranche.
Okay.
And the senior tranche is going to give up some of the yield. Let's just say the yield is 10%. And the senior tranche, let's say the senior tranche is going to be 90% of the kind of split. So you'll take $1 and you do 90 cents into senior tranche, 10 cents into junior. But then the senior tranche, let's say rather than getting 10% yield, 90 cents worth of yield, let's say they cut that in half. I'm going to use some exaggerated numbers here. Let's say they cut that in half. So now the senior tranche is only getting 5%. So on their 90 cents, they're now only getting, that would be like 4.5 cents. So then you say, okay, well, what happens to the other, I guess that would be 5.5 cents of yield that comes off the kind of overall bucket? Well, that would all go to the junior tranche. So now if you're paying attention, the junior tranche is getting 5.5 cents of yield, but there was only 10 cents put in there. And so that's a 55% yield. So the senior tranche is getting 5, the junior is getting 55.
All right.
But what happens is if the underlying goes down, the junior is first completely consumed and deleted. And so if you're sitting in that 10% junior position, then you need the asset to go down by more than 10% before the senior starts getting impacted. And so these different these tranching protocols can be set up in different ways: 10%, 15%, 20%, whatever split, and then different yield sharing as well. And the idea is for some investors that like the product, they like the APY USD product, but they're like, hey, Stretch might depeg a little bit. Early on in the interview, I talked about, hey, it's not exactly a stable coin, right? It's more of a yield coin. It can fluctuate a little bit. If you say, hey, I don't want any of that fluctuation, I think Stretch is going to depeg some. I think it's going to go down 5% or 10%. Too scary. I don't want to lose my money. You can say, okay, well, I'm going to go into the senior tranche and I'll give up some of my yield, but I'm going to have that protection built in there. And so it's just another way for folks to get access to the product, get access to the yield, but express a different kind of risk return profile and view than they, would on the underlying.
Okay, that's a good explanation. I think, okay, so let's talk a little about lending and potentially looping. I'm looking at your lending page here. And this is just showing back to your point. This is on Morpho, I think. Let me kind of zoom in on that so people can kind of see it there. That's on Morpho. Explain the strategies that people might use on this.
So there's a couple different things you can do here. We've got two different types of markets. We've got markets where you could lend APX USD, and then there's markets where you can lend USDC. So the markets where you can lend USDC, those are nice and easy for folks that don't want to leave USDC. Maybe there's a vault that already has USDC. They can just lend in. It's nice and easy. But for people that want to take the other side and want to borrow USDC, there is some liquidation risk, right? So Stretch could drop. The price of APY USD can go below 1. And then if it goes far enough, you could be liquidated. So some folks don't want to take that risk. And so they would rather borrow APX USD. And APX USD shares the same collateral basket as APY USD. And so therefore, basically can't get liquidated. I mean, you could have a liquidation due to an interest rate differential, but that's a slow liquidation over time. And you should have many, many days, weeks, months even, to kind of unwind the position if you wanted. And so if you're looping, the safest way to do it is to borrow APX USD to then loop more APY USD or PT, one of the PTs there. So what that means is people that are doing the APX to APY loop are going to take a higher LTV most likely because there's no real liquidation risk. It's just the interest rate differential. And so what that should mean is that for lenders on the other side, they can make more money lending the APX USD than they can lending the USDC. And that would make sense because they're taking on a little bit of that DPEG risk, the APX USD. And so, like you highlighted there on the site, right now you can lend APX USD against one of the markets and make 16%. That's actually more than you can make just holding APY, the staked version. So this market's a little upside down and people can make kind of free money here. But that's not always the case, right? And probably long-term steady state, the yield lending APX USD is probably going to be a little below the yield from just staking it, but they'll probably be somewhat similar. And so there's a bunch of different ways to play this, hedged, unhedged, people that really think Stretch is going to depeg and don't want to take that underlying risk. There's actually many different ways that you can play this and still capture yield. And in fact, if you want, you can just borrow APX USD and sell it, and you could go straight short the whole basket. So to anyone that's like, this is a dumb idea, this is a shit coin, it's all going to break, awesome. You can come in and short it. We would appreciate that because that's yield that flows back into the system for the lenders, but you can express a view, which is pretty cool.
And you can kind of see, we've drawn these green lines in here. Each one of these are distribution dates. Just had one last Friday. We saw what typically happens because people, sell into those. Market dips slightly. Again, Bitcoin down slightly, but the point is market dip. When is the best time to buy Stretch, do you think?
It's a great question. So there's a couple different ways to play this. You can buy the day before ex-dividend, and you'll be guaranteed to get, let's call it 1% roughly, right? If the dividend was 12%, then you'd be getting, 1%. And that's one way to play it. And then you just basically have to hang on until potentially all the way to the end of the next month, potentially for 30 days for the price to recover. So that's one way to do it. And that's kind of the nice set it and forget it way to do it. The other way to do it is you can wait to buy until ex-dividend. So you're going to skip out on the dividend, but you're going to potentially be buying at a discount. And so if you bought on Friday or on a day like today, actually you can get a little bit more of a discount than the dividend would suggest. So right now it's trading at, if you bought today, you could generate, a little more than a 1% yield by holding for the next 30 days. And so sometimes it drops more than the dividend amount. And so you would be better off waiting and then just buying the dip. And then sometimes it drops less, at which point you would have been better off just buying the day before ex-dividend. So there's kind of two different ways to play it. And the goal, though, over time is as they shorten the dividend, they go to bi-monthly and then hopefully daily. Some of these games kind of go away and it just becomes a more friendly product where like you can just go to your brokerage account, buy it any day of the week, and you get the same returns. That's kind of the end goal.
I'm looking here at the xStocks points that you earn on the Apyx Reserve, and then pips issued. Explain how this works.
So pips are our point system. So we are offering points, and these at some point will be convertible into governance tokens, the APYX token, which is going to be the standard governance token for the project. But then through our relationship with xStocks, and xStocks is owned by Kraken, and basically the entire team at Apyx is ex-Kraken. So we've got a great relationship there. We are holding a decent chunk of our balance sheet in STRCX. Okay. So the xStocks tokenized version of Stretch. And so they are also having their own points program. They offer points. And so we are the largest points earner for xStocks, and just wanting to highlight to the community that, we have all these points, and we will, whenever the xStocks airdrop happens, we'll be getting a bunch of tokens, and that'll flow through into the reserve. We can potentially pay it out to governance token holders or pay it out as yield. There's a bunch of different things we could do with it. But this is like an extra asset. We've not accounted for it yet in the reserve just because it's points, but like we're showing where we are.
Yeah. All right. So you look at Ondo versus xStocks. Who do you think wins retail, especially to what's happening in the market right now?
Sure. Well, I'm speaking a little biased here, but we're certainly bulls on xStocks. We have a partnership with them. On the DFDV side, our stock is tokenized, so DFDVX is out there in the market. So we're certainly bullish on xStocks. I do think there's probably room for multiple players just because there's so many real-world assets out there. Now, do I think there's going to be two versions of Stretch dominating the market? No, I actually think there's just going to be one version of Stretch, and it's maybe it's going to be Stretch X, but there's so many different instruments, right? There's common stock, there's preferred stock, there's bonds, there's funds, there's all sorts of things that need to be tokenized. And so what I imagine is going to happen is Ondo and xStocks are going to carve out their own niches. And, if you want to trade Tesla, maybe it's on xStocks, but if you want to trade, a treasury bond fund, then maybe it's on Ondo. Again, I'm just making things up here, but I think you're going to see some bifurcation, because I do think one or the other is going to win certain asset categories and dominate, because it just makes sense, right? They're just going to have liquidity kind of concentrate around one standard, if you will.
Well, and we have seen some of that, in TradFi that has gone in. You get specialists that, focus in on certain types of instruments versus others. So you might be right there. As far as clarity and the Clarity Act, what we'll see in this next generation of the market structure, how will this affect you guys? What does this enable for what Apyx is doing? Yeah,
so I'd say for our business, clarity really just adds some clarity, kind of codifies a number of the things that the SEC and the CFTC has already come out with. And so it just makes it longer lasting. And rather than a administrative rule, which can be overturned, with the next administration, this kind of codifies it into law. It doesn't immediately enable us in any way, but I think longer term, as some of the rulemaking comes out, it will become a long-term catalyst for our business, because it just provides that clarity, that stability for us to build larger and larger, and for larger entities and institutions to come in and participate, because they do have that clarity that like, hey, here's the rules of the road, and it's not just going to be completely changed with the next administration. So I think it's a good long-term tailwind, but immediate catalyst, not really.
There you go. Hey, Parker, thanks for coming in today, because this has given me even some great education, I think, around what this market is going to look like in the future. And it's intriguing because, obviously as this centers around Bitcoin with what Strategy has been able to do, we watch it really closely. So thanks for coming in today. We appreciate it.
Thanks for having me.
If you like this video, hit like and subscribe, drop a comment down below, and also join our free private member group. The link is in the description.